Whole Life has a black eye. And when I used to be with a different company than the one I'm right now, they sort of give you the doctrine on why Whole Life is evil. And typically they say there are four things that are wrong with Whole Life. And Whole Life would say, well, what are they? Well, one, for the first 2, 3, 4, 5 years, the money that you've deposited into the savings, it's not yours. And then during the course of your policy years, say you're into the policy 10, 15, 20 years down the road, and you have, say, $50,000 accumulated in the savings. And so you need to pull out some of that money. They will loan you that money out, which is not necessarily a bad thing. They'll loan you that money out. And typically the loan interest on your own money is 6 to 8%. So I think very similar to the banking business, and if you were to pass, the thinking in general would be that your family should receive the $500,000 plus the $50,000 in cash value. Well, if you have a whole life policy, that's not the case. The insurance company will...
Hi, everybody. Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today, we have a repeat guest. His name is Guillermo Haro. He is a senior executive vice chairman at World Financial Group. He's been with the company for over 23 years, and today he is going to be answering the question for us, what is permanent life insurance? He's going to be giving us a little bit about the history as how permanent life insurance has evolved over the years, and then he's going to be giving us the different pros and cons of each of the products. Welcome back to the show, Guillermo. How are you?
I'm doing great, brother. Thank you for having me.
Of course, of course. So for our viewers that don't know who you are, who is Guillermo Haro, and then how did you get involved in this wonderful world of life insurance?
All right, well, good. Everyone, my name is Guillermo Haro. I'm a senior executive vice chairman with a company called World Financial Group. World Financial Group is a telling name. We're throughout North America. World Financial Group is partnered with a company called Transamerica, also owned by a company called Aegon. They're our parent company. They're in the Netherlands. As a matter of fact, Aegon just recently had a show on CNBC. We had our CEO, Lard Freeze is his name, and talks about how on coming up here in June, there's going to be a big meeting that displays the power of WFG through Aegon across the world. So very excited about that. WFG has massive momentum. There's so much stuff, good stuff going on. And it has a lot to do with the products that we offer the consumer.
I love it. I love it. So today was actually the first time that I've heard the term versus perm. So what is the difference between a term insurance policy and a permanent insurance policy? And then we can dive into the history of the permanent insurance policy.
Sure. Well, first of all, term insurance is your basic life insurance policy. In general, it's basically my opinion that I think most people should start off with a term policy just to kind of get their feet wet. Term insurance has been around for many, many years, over 100 years. It was the initial form of life insurance. Matter of fact, there's biblical sayings that it started way back from the Roman days when people would pool their money together, and then when someone passed, the pool of that money would now make that family whole again. So insurance primarily is based on replacing the income of the breadwinner. So if we have mom and dad, the dad makes 100 grand a year, the mom makes another 100 grand, or say half or whatever the number is. And if an individual, a breadwinner, is to pass away, so the family suffers two major losses. Loss number one is the emotional loss. Like I lost my dad when I was a young man. And so I never could see my dad again. There was emotional loss. It hurt. I could never hug him. I could never kiss him. I could never hang out with him anymore. So when you lose someone, there's that emotional loss. So as an insurance company, we can't do anything about that. But then on top of that emotional loss, you also have economic loss. So do the numbers. If someone earns $100,000 a year and they're 40 years of age and they're going to work for the next 20, 25 years of their life, with the same amount of income coming in every single year, you take $100,000 a year times 25 years, that's $2.5 million that breadwinner was going to bring into the household during the course of their working years. So if they pass away prematurely, the family is going to lose the breadwinner, the emotional side, and also the 2.5 million of future income. So you buy a life insurance policy to replace that future income that person was going to bring in. So you buy a large amount of insurance for a small amount of payment, and that's typically the concept of a life insurance policy, starting off with term. So most people that have limited budgets, they're not really making big money in order to invest in other types of insurance. They should buy a term policy, and the term business is very competitive. There are many, many companies who offer great products out there. We have a host of companies underneath our umbrella that offer term. They're very competitive. Some of them have bells and whistles that are a little bit more advantageous than others. But in general, term insurance is you buy a block of time, 10, 20, or 30 years of coverage. And after that block of time, basically all bets are off. No more payments, but no more coverage, unless you have a product called return of premium term, which is obviously more expensive. And it's not as popular, but overall, most people that buy term insurance just buy straight life insurance for 10 or 20 or 30 years. There are exceptions to that depending on the companies, but that's basically the details on term insurance for most companies with most agents.
Great. Now, can you convert a term policy into a permanent policy? And then we can dive into what is permanent life insurance.
Yeah, absolutely. There are many companies who sell term. As a matter of fact, I believe most of them who sell term insurance. There might be one or two that doesn't. There are companies who strictly only sell term, and obviously that's a little bit of a sad proposition because they only have one product to offer the consumer.
Offer.
So most companies that offer term do have the opportunity to convert that term policy into a permanent policy without necessarily having to requalify the client for additional medical requirements. So you can convert that term policy into a permanent policy. Now, Jose Luis, there are different species of permanent policies. The most known, the oldest type of permanent policy out there is one called whole life. And so if we can dive in a little bit on whole life basically means you have permanent life insurance coverage, and you also have a savings component attached to the policy. So every time you make a payment, some of that money goes to the cost of insurance. Some of the money goes to the fees associated with holding the policy. And then the ideal situation is that most money should go to the savings component. It's called policy value. It's also called cash value. It's also called accumulated value. Whatever the name is, it's still the same thing. So basically, it's money that the policyholder is accumulating inside the policy. So it's permanent life insurance with basically a savings account, and that's whole life.
Now, after whole life, you were mentioned to me off camera, and this is kind of the first time that I heard about this. And the reason I brought up this interview, just for our viewers to see, I read a book. It was called "What Would the Rockefellers Do?" And the
Mm-hmm.
reason I read that book is because I'm very well versed in real estate, but not as well versed in insurance. You were mentioning to me that whole life has evolved over time. Can you tell us about that evolution, or not whole life? Permanent life insurance has evolved over time. Can you tell us about that evolution?
Yeah, well, whole life has had its challenges. Many people consider that whole life, the product whole life, has a black eye. And when I used to be with a different company than the one I'm right now, they sort of give you the doctrine on why whole life is evil. And typically they say there are four things that are wrong with whole life. And whole life would say, well, what are they? Well, one, for the first 2, 3, 4, 5 years, the money that you've deposited into the savings, it's not yours, it's the insurance company. So if you look at your account, it would say 0, 0, 0 for the first 2 or 3, 4, 5 years, depending on how much you're putting in. So the insurance company keeps your money for the first few years. In other words, they don't credit you those deposits. And then number two, whenever they do start crediting you the money to your deposit, you earn a very modest rate of return, about 1 to 3%. Some companies would argue a little bit different. They might be true, but in general, over the years, 1 to 3% is basically what they give you. And then during the course of your policy years, say you're into the policy 10, 15, 20 years down the road, and you have, say, $50,000 accumulated in the savings. And so you need to pull out some of that money. They will loan you that money out, which is not necessarily a bad thing. They'll loan you that money out. And typically the loan interest on your own money is 6 to 8%. So I think very similar to the banking business, you deposit money in the bank, they pay you less than 1% or say 1%. But if you borrow money from the bank, they charge you 12 to 18%, say on a credit card. So you have that same sort of dynamic in a whole life policy where they're going to pay you 1 to 3, but then if you want your own money, you have to apply for it, and then they charge you 6 to 8% to borrow your own money, and you pay it back, or they reduce it from your cash value. And then the big sort of the big issue here with whole life would be that if you have, say, a $500,000 coverage, that's your permanent value, the amount of insurance, and say your cash value grows to say 50,000, and if you were to pass, the thinking in general would be that your family should receive the $500,000 plus the $50,000 in cash value. Well, if you have a whole life policy, that's not the case. The insurance company will basically allow your beneficiary to pick one or the other because you don't get both. You don't get the $500,000 of insurance and the $50,000 of savings. You're going to get one of the other. And of course, the family would select the $50,000 as money that they're going to forfeit to the insurance company, and then they're going to order the death benefit for 500,000. So in many cases, the client would be looked upon as they're as much of an insurance company to the tune of $50,000 as the company they're paying a premium to. Said another way would be the insurance company gives you the 50,000 of your money and $450,000 of their money to now make you whole at 500,000, but they do not give you the 500,000 plus the 50,000. If you follow, make
I
sense?
love it. So how is that different in universal life? How is that different in index universal life? And how is that different in variable universal life? Which, if I'm not mistaken, those are the different four types. There's four different types of permanent life insurance. It's
Yes.
whole life insurance, universal life, index universal life, and variable universal life. How is that? How are those four components different?
Correct. Well, with the universal life concept inside the policy, depending on the agent selling it to you, you can select the amount of death benefit your family is going to receive. So there's a thing called level, and there's also increasing. So level would be the concept that we just explained in whole life, where you're going to get one or the other, not both. So you're paying for the insurance, you're also putting money in the savings, but the day you pass, your family is going to get one or the other. That's considered level death benefit. So you bought $500,000 of insurance, that's all your family is going to get upon your passing. Now, with the universal life concept, if you have increasing, so your agent would check the box level or increasing. So if your agent selects the box of increasing, the insurance company is now going to give your family, your beneficiaries, both the death benefit plus the cash value. So that's called increasing benefit. And that applies to the universal life, the index universal life, and also the agents that are securities licensed that can offer you what's called variable universal life, which is a little bit more of a volatile product, but in the up markets, it can actually work out for you as well.
I love it. Now, when you say that they either check off a box level versus increasing, are there certain incentives for the person to check off one or the other? And then also, like, are there certain pros and cons? Like, is there a positive of checking off the level one? Like, meaning, is it less expensive than the increasing?
Yeah, this could be argued both ways. I've seen the arguments both ways. I'm personally not convinced that if I pass away and I've been able to build my cash value, I'm of the belief that my family should receive the amount of money in my savings in addition to the insurance. So that's my personal opinion on that. Now, there are other people who would argue the other way, who are convinced that you should only get level so that you forfeit the amount of savings. I guess the amount of savings you have is your willingness to forfeit them to the insurance company. But if you properly fund, that's super important. So everyone listening here, if you're going to buy an index universal life policy, don't your question should be, how much does it cost? So this is an investment. It's like if you're going to start a stock account, if you're going to open up an E-Trade account, or if you're going to open up a Charles Schwab account, you don't say how much does it cost. You just basically start funding your account, and you want to overfund it. So I'm a big believer in putting more money into the policy than what's called the target. The target is a number that the insurance company recommends you ought to put in, and that target is basically going to make the policy go. I'm a big believer in overfunding the target amount. So if your target amount is say $5,000 a year, I'm not I'm not going to recommend you just do the $5,000 a year. I'm going to recommend you do double that, or maybe 25% more, or 75% more, or 50% more. But I'm going to recommend that you overfund the policy, so therefore we can really beef up the savings. The purpose of a permanent life insurance policy is that your cash compounds over years, especially if you're in your 30s and you buy a policy and you're going to pull out the money in your 60s. So you have 30 plus years of compounding. So the more money you put in every month, you have more money compounding. It's kind of like I always mention it to my clients. If you have, say, a mountain, like right now it's just snowing, and you take this snowball at the very top of the mountain, and the bigger your snowball that you let roll down the mountain, the bigger the snowball at the top, the bigger the snowball at the bottom. When it rolls down, it picks up more compounding. So if you can take that concept, if someone starts a permanent policy with a lump sum, 10,000 or 20,000, so someone who has money in the bank doesn't necessarily need it. They got 10 grand in the bank earning less than 1%. Take that 10 grand, put it in your permanent policy, start the compounding going. If you get 6 to 10% average return over the course of 20, 30 years, now that's the way you could really accumulate some wealth for your retirement.
Not only that, but like when you say that you start building up a savings account, a cash value, what can you do with the money in it? Like, so I have a 401k. In the 401k, I'm limited to taking out $50,000 a year. If not, if I take out, or not a year, $50,000 loan. If not, there's penalties. Like, what is the difference between a life insurance policy or permanent life insurance policy with taking out money?
Well, there's some huge tax advantages to people who own permanent life insurance. The tax code really favors the life insurance industry. And I guess that's a big benefit. There are multiple books that I can share with you guys. There's one right there. There's another one right
The
there.
laser fund,
Yep,
how money works.
absolutely. And then this one is really big time right here, guys. This is a big time one.
I just bought that
So,
one.
oh, beautiful. Okay. So it mentions how money inside a life insurance policy has measurable tax advantages. And so a lot of people are not aware of that because think about it. Most people who invest money, you're a traditional family who has a job and they go to their employer. So their employer is sort of their source of retirement. Most people have more money in retirement savings with an employer than they do on their own. And so we'd like to maybe potentially guide them in a different direction. The minute you select a 401k as your vehicle, there's some good benefits to having a 401k. One is the habit of saving money, which is good. Number two is if they match you. But the challenge with that, Jose Luis, is that we have a number of growing, so many employers that no longer match. Companies are challenged with their fiscal numbers, and so they don't have enough money to really match or give a percentage of their profits back to the employees who are putting money in a 401k. So an individual who's putting money in a 401k and is not getting matched, and the benefit would be that they have tax deferral right now, but then sooner or later in their 60s, 59 and a half is the rule. Whenever you access the money down the road, you shall pay taxes at the then rate. So that becomes a challenge. What is your tax rate today? Well, someone would know their tax rate today. What is your tax rate when you're 60 years old? The answer is you
Nobody
don't
knows.
know. So the question would be is, do you think your taxes are going to be higher at age 60 versus 35? And based on the history of our country and its tax policy, taxes tend to go up. So the notion would be is it better to defer the taxes right now that you know the amount, or pay more taxes down the road, theoretically, when you're making less money? So that's sort of a catch-22 where people are caught in a position where if you're no longer working in your older years, you're no longer working, and now the theory is that you're going to pay less taxes because your income is down. I guess that would work, but think about the situation someone would be in. It really, 401k in that regard really works for someone who intends to be financially challenged in their senior years. And from what I tend, no one wants to make less money when they retire. People want to at least hold the same quality of lifestyle. So people prepare themselves through rental income, through dividends, through a number of different income sources. So therefore, the day they stop working, their pension, Social Security, rental income, a number of different income sources come together, and that way your income remains the same. So that means your tax bracket would be the same as when you were working, but the fact that taxes go up over time. So that is a challenge with putting money in a 401k for tax me later. We, in many times, compare that, says, Mr. Consumer, Mr. Client, it might be better for you to pay your taxes now and then have a tax-free retirement. There's something to be said about all the eggs in your basket when you retire, all of them are yours. You don't have to share any of them with the government. And so that's where permanent life insurance comes in. The money you access from your policy in your senior years is tax advantage, is not taxable. So that's a huge benefit. And so this, in this book right here, it talks about how the life insurance industry is actually helping families retire with more wealth.
That's actually the book that I just bought. Now, the only question I had about that statement is if you're putting tax-free money up front or upfront, wouldn't that be able to compound more over time?
I think, repeat your question one more time. I want to make sure I'm understanding the way you're
So
saying it.
I'm basically saying that, like, one of the options is pay the taxes now and then obviously grow tax free over your 30, 40 years, however it is. If you don't pay the taxes now, you would have more money to put in an account, and then it'll compound. Would it compound bigger than the taxes than what it would if you paid the taxes now, basically?
Well,
Would it compound bigger more than the taxes that you would pay in the end, basically?
yeah. Well, there's two things. There's two things that's a great question, and there's basically two ways to address that. One, if you defer the taxes, you put your money in a 401k. Well, we understand that a 401k is directly tied to the performance of the market. So the market has volatility. There's fluctuations. There's swings. Like, look what's happened last year and this year. So
Yeah.
picture someone being, for example, 58, 59, 60 years old, and your money is in a 401k, and you have, say, 200 grand in your 401k, and then 2022 hits, and now you're down 20%.
Yeah.
So what's it like to be 60 years old, and all of a sudden 20% of your retirement dollars are gone to the volatility of the market? Okay, now, so that's gone. Then when you do start pulling it out, whatever you do pull out, you got to pay taxes on it. So there are two big concerns there, is that you have market losses and you also have taxation. So you have a 401k, there's market losses and taxation. Now, what if that same consumer had chosen the permanent life insurance vehicle, an IUL, an index universal life policy, a universal life policy, a variable universal life policy? The variable universal life functions very similar because it's directly connected to the performance of the market. So many people don't want the volatility of the market. So then variable universal life might not be for most people if they don't want the volatility. They don't want the possibility for loss. So now we look at index universal life, which now the big sell with an index universal life, that it locks in your gains. So the minute your cash value gets up to, say, 15 grand, it's locked in. Then it gets up to, say, 20 grand, it's locked in. When the market goes down, your last big amount is locked in. So during the course of your life, your account goes up, and every time it reaches a new high watermark, it's locked in. So for your next 20, 30 years, you only make money, you never lose any money. You follow?
I
So
do.
that becomes a huge advantage. And so you've eliminated the concept of losses, because every single year you don't suffer any losses. So when the market turns south, you don't lose any of your principal in your account. The other big benefit is the dollars that you've accumulated over these 20, 30 years that you've been saving, you now have access to that money tax free. So we look at a 401k, which could lose money and it's taxable, versus the IUL, it's not going to lose any money and it's not taxable. So one of them is 0 for 2, the other one is 2 for 2. I mean, it's pretty simple to understand.
Now, when you say it's not taxable, that means that you can use that money at any time. You don't have to wait till you're 59 and a half or until you reach retirement age like a 401k, right?
Yes and no. A life insurance policy has a thing called a surrender charge. This is one thing that a lot of agents don't disclose to their clients. So it's a surrender charge, meaning your availability of accessing those funds. So typically, most policies for the first 10 years, you shouldn't pull out the money in the account. It's not an ATM machine. You should buy a policy with the intention of keeping it long term. So the purchase of a life insurance policy, the intention of it is to save and save and save continuously over the course of many years, and don't touch it, because the reality is it's going to be for your retirement. So you shouldn't be using your retirement dollars to fix your faucet at home, or you shouldn't use it for to buy new rims or vacations, or any stuff like that. So keep it for its intended use. The cash value inside your life insurance policy, the intention of it is let it compound, let it grow, do not pull it out. Now, if you do need to pull it out, you can ask the insurance company for a loan. So there's, depending on the policy and the company, you can pull out what's called a policy loan. There's also a full redemption, depending on the amount of years that the policy has been in force. So overall, once a policy is a little mature, it's 10, 15 years old, you typically have access to the money before you're 59 and a half, without the penalties and without taxation.
Are there any policies that would give you access to the money immediately?
Yes,
And this is kind of
yes.
what I read in the book. What I read in the book as well too is that because you're borrowing against your life insurance policy, you're not borrowing your own money, so therefore the money continues to compound.
Yeah, that's also dependent on the policy. Not all companies offer policies with those features, so you need to be cautious with what company can do that. And by the way, oftentimes you have agents that just say that because they heard a video on TikTok or Instagram where it sort of sells it that way, and they don't necessarily sell that product on there. Keep in mind that it's a bank account. Just look at it as a bank account. If you have $50,000 in your bank account and you pull out 30,000, well, your balance is no longer 50, your balance is now 20. But there are people who says no, the insurance company will credit you the entire amount, so that your entire $50,000 will continue to accumulate interest, because you're borrowing the money, you got to pay it back. So depending on the company and the product, we need to be very careful with the wording inside the policy. There are provisions that allow you or disallow you to do that. So both are out there, and so people need to be cautious with the intention of this. If you're a big time investor and you're going to be pulling money in and out of the policy, then you need to be aware of the amount of money that you have access to. So insurance companies and agents, we have a thing called an illustration, where they show you what the numbers are going to look like next year and the following year and 5 years from now and 20 years from now. They can project these numbers out as far as 50 years if you want them to. And so you need to study those illustrations, become educated. The best way to really know what's best for you is to have a good relationship with your agent, ask questions, make sure you do a little bit of your homework, and then know that there's pros and cons with every product. There's no one product that's perfect for everybody. Matter of fact, permanent policies are not for everybody. Permanent products are not for everybody. If you don't have the financial discipline to keep investing long term, it's probably not for you. There are people who are financially challenged where they says, well, I get paid on Friday and it's Tuesday. Those people that are living paycheck to paycheck, that's pretty, we feel for them. It's a pretty severe situation. Chances are an IUO is not for them now. So someone who just has really bad money management skills, they don't know how to manage their money, they're really poor with money, with handling money, an IUO would probably not be for them as well. Someone who has really bad credit, doesn't really know how to budget accordingly, it's probably not for them. But people who want to improve their situation, want to commit, because that's what it is. An IUL, a permanent policy, is a commitment. It's typically a long-term commitment. And if people don't hold to the long-term commitment, then it doesn't really benefit them. And quite frankly, insurance companies are looking for longevity. They want long-standing clients. If I'm an insurance company, I want you to be on the books for 30 years. I'd like to collect premiums for 30 years because that makes my shareholders very happy.
That's great. Now, what happens, like, and I read this in the book, and I keep referring back to the book that I read, but what happens if you stop making the payments? Like, let's say you sign up for like a whole life insurance policy or a universal life or index universal life, and you stop making the payments. Does that mean that the entire policy stops at that point? Or what happens to the cash value that you've actually saved up in that policy?
No, that's actually a really good question. And that's one of the big benefits of making sure that you're properly funding the policy. When you have a policy that's being properly funded, and then down the road you run into economic crisis where you can't continue to fund it, if you have thousands of dollars in your account, you can call the insurance company and says, hey, can you put a hold on my payments for the next 3, 4, 5 months? I can't make any payments. The cost of the policy will be paid for with the savings in your account. So you still have the insurance, you still have the savings. Your savings is not going to grow as much because you're not pumping any more money into the account. But if you don't make payments every single month, it does not mean that your policy is going to lapse without value. So that is one of the big benefits. Most policies, if you read the front of it, it says flexible premium life insurance policy. So it's flexible. It's kind of like, if you have a mortgage, you can send more money to the principal. You can send the fixed amount, or you can send more to the principal to reduce your principal balance. If you take the flip side of that from an investment standpoint, you can send more money to your principal, or you can stop making payments. You can make some withdrawals. It's flexible. It gives you the opportunity to do things with it that ordinarily other accounts don't offer that type of those features.
So if you were somebody like me who maybe is not an expert, like maybe some of our viewers were not an expert in permanent life insurance, obviously you've mentioned flexible premium, you've mentioned full redemption, you've mentioned surrender charge, you've mentioned level versus increasing. Like, what questions would you ask your life insurance a friend as to how to create not obviously not all the life insurance policies are going to be perfect, but create like the best possible outcome? Or like, what would you be like? Have you ever seen insurance policies where they're like, oh man, they shouldn't have done this or shouldn't have done that, they should have designed it
Yeah.
this way? what
Yeah.
what should somebody like me look for in that aspect?
Well, number one would be, I think you should do business with someone you know and you trust. I mean, you got to trust them. This is, at the end of the day, it's like we have to trust the people we go to. I mean, do you trust your dentist? Do you trust your doctor? Do you trust your attorney? Do you trust your tax preparer? So trust has a whole lot to do with it. And just you probably want to do business with someone who's been in business a while, or someone who's working with someone who's been in business a while. That would be an important thing. And then someone you can sense when someone's speaking very honestly and very clear with you, and be direct about what is your outcome. In your scenario, we're always talking about the concept of the agent really getting to know the client. So in our industry, we have fiduciary responsibilities so that we're doing the right thing for the consumer all the time. Not necessarily does that happen all the time. Obviously, there's bad apples everywhere in every industry. But the important thing is that the agent really gets to know you. So we have a requirement called KYC, know your client. So your agent should be asking you questions about your age, about your income, about your current debt position, how many children do you have, um, what is your objective, what is your goals. So your agent should really get to know you. If your agent just wants to close you and write a policy real quick without really getting to know you, then that might be a little bit of a red flag. So he didn't really get to study your situation, and all of a sudden he's just trying to close you on a policy that's maybe a little bit not compliant, and that means that they're just more interested in quickly getting their commission rather than really serving you. So take the time to make sure that you understand what you're buying, ask questions, make sure your agent is asking you questions, answer honestly, because remember, life insurance policies are valid when you are truthful. If you lie, if you defraud, if you omit, there are consequences that can come as a result of the client not being completely truthful about the questions on the application.
Awesome. um would you describe to me, like, okay, so like I understand whole life insurance policy. What's the main difference between universal life and index universal life? And then the main difference between index universal life and variable universal life?
Well, let's start off with the variable universal life. One, it's the agent selling it to you has to be securities license and insurance license. So that's called duly licensed. They have to be what's called a registered representative. In my experience, over all the years that I've been in business, there are less and less registered reps out there. So most people, because there's a heavy compliance and there's lots of requirements to hold those licenses, there's fees. So you got to be part of a broker dealer. So if you have a variable universal life, that means that you're willing to stomach the ups and downs, the volatility of the market. So the word says it in itself, variable universal life. So that means your cash value will go up and down based on the performance of the market. So that's variable.
So, and what are the pros and cons? Like, obviously, like it sounds like you can potentially get a much better return, but there's also the chance that you may not get a much better return. Any other pros and cons as it relates to variable?
No, that's typically it. That's the biggest one. It's basically your client's ability to stomach volatility. I mean, because the
Almost
market
like
can.
the stock market, basically.
Absolutely, absolutely. So a variable universal life is money directly tied to the performance of the market, and so you go all the way up with it, you go all the way down with it.
Okay. And then
So
index universal life,
yes,
that's where you hear the term like almost like a guaranteed rate of return, or is that different?
no, no, no. There is no guaranteed rate of return. The guarantee is that your principal is never going to go below where it's at. So if you have $50,000 in your cash value and the market drops, the stock market really gets hit hard, your 50,000 holds at 50,000. You do not go down with the market. So that's the the floor protection. So there's a floor and there's a ceiling. Typically most companies will offer you a policy that has a floor, 0 to maybe 1%. And then there's a ceiling. Some companies offer a ceiling of 13%. Others may have 15%, 18%, up to 25%. So there's a floor and then there's a ceiling. And typically, as long as you can live with the fact that you're not, for example, you're not going to make more than 15% and you're never going to lose any money. And then most of the time, you're going to be in between 6 to 10%. If you can understand that, then index universal life is for most people who are going to buy a permanent policy.
And do different companies offer different floors and ceilings? And
Yeah.
does that affect the policy price as well too?
Well, it's more and more of a competitive market out there. I think the industry has evolved. There are companies that are very thorough with their marketing strategies. There are companies that don't offer index universal life at all. So there's some, traditional, more established companies that do not offer any of the index. They only offer whole life. So in looking at these different policies, finding out which one would be best for you, I would say for most people out there that have the ability to fund it long term and they're doing relatively well financially, index universal life would be a very good bet, and there's not a whole lot to lose there.
You know, it's funny when you were describing the different policies, that's the one that I gravitated more towards, because in the book it also said that it's all about compounding, and there are two things that stop or a couple of things that stop compounding. One of them is when the marketplace drops, because not only you have to recover what the marketplace drops. So if your principal balance never goes down, it actually can accumulate or compound at a much better rate. Now, so index universal life and then universal life. What are the pros and cons about universal life?
Well, the universal life doesn't have the index. It just has more of a guaranteed rate of return, anywhere in between 3 to 5%. So it's a decent product. I would say universal life. There's less, in my opinion, based on what I've seen. There's less and less universal life policies being sold because index universal life is so attractive. I mean, a universal life policy will never get you 10% return, but an index universal life policy can.
It
So
can with less, with not less downside, but very
with
little
no
downside as well too.
yeah, with no downside.
No downside
Yeah.
whatsoever.
I wanted to also comment on what you just said, where the name of the game is the compound. It's like, how quickly can your money double? There's this thing called the rule of 72. Many of us have heard of that before.
Mhm.
And so the rule of 72 talks about how long it's going to take for your money to double. So if you're getting 4%, you take 4% into the number 72, gives you 18 years. So whatever money you have in your account, it's going to take you 18 years to double at 4%. Well, if you flip it around, what if you were to get, say, 12%? So 12% into the number 72 is 6 years. So now your money is doubling every 6 years. Here's the deal. Everybody who wants to have a very comfortable retirement is looking for those doubles. And what's the product that's going to allow you to get those doubles without the volatility, without the risk, without losing sleep at night? without being in a position where you're worried that the market can go down and you're going to lose money at the most inappropriate time.
Additional questions about universal life, index, and variable. You mentioned early on that your savings doesn't start to accrue in a whole life policy for 2, 3, 4, 5, 6 years. How does that work in universal, index, and variable?
What also, I also want to say that very cautiously because it depends on how the agent is recommending the client start the account. So, Jose Luis, let's suppose you're my client. I'm going to start you off selling you a permanent life insurance policy as if I were selling you a property. So if I'm going to sell you a $500,000 property, I say, okay, Jose Luis, we found the property is $500,000. Do you need a down payment to buy the $500,000, the $500,000 property? And the answer is yes. How much do you need? Let's just say 10%. Well, 10% of 500,000 is 50,000. So if we can look at the purchase of a permanent policy very similarly to the way you buy a property, now you front load it or a lump sum or down payment with 50,000, and then we put a couple of $1,000s a month into the policy. Now you have that snowball we talked about. You have the $50,000 that's going to work for you immediately. Plus every month you're now going to put in, say, $2,500. So now you have a very healthy policy that's being properly funded. You follow?
Yeah.
Now, the surrender charge immediately minimizes because you put in more money at the beginning. So in other words, skin in the game, you have more money that you put in. It's kind of like the people who buy real estate with a bigger down payment. Those are the properties that get less foreclosed on. So someone putting in 3.5% down payment versus 20% down payment, 10 years down the road, how many 20%ers got foreclosed on versus how many 3.5%ers got foreclosed on? So very similar to that. So the concept is the more money you have in the policy from the beginning, the less likely is that that policy will lapse, that you'll stop making payments on it. You'll now pay attention. People who pay attention. And so it's important to look at the money that you put into the policy at the beginning and how consistently you can fund it. With proper funding, the surrender charge becomes less and less of an issue as years go by.
Awesome. This is great. Anything that we might have missed, Guillermo, as it relates to permanent life insurance that you think is important?
Well, there's several. I mean, the conversation could be very long, but overall, we mentioned permanent life insurance policy should be one of your bigger ticket purchases. If you're in that position, your income is good, you have a forecast of your future as being properly funded, then I would say an IUL would be good for you. Here's a couple of things here. Don't buy an IUL when you're minimally funding it. People buy IULs for, say, they're an adult and they just put in $100 a month in an IUL. That doesn't necessarily go very well because, I mean, the truth is you're going to pay for the cost of insurance of the policy, which does increase over time. That's one thing people need to know versus term is fixed, and whole life can also be fixed. But the cost of insurance inside a permanent policy does increase over time. And also every single month you have the policy fees. All financial instruments have monthly fees. So if you're covering the cost of insurance and your fees, and then there's a greater amount, the lion's share of your contribution is going to your policy value, and you can see it on the illustration, the numbers that your agent shows you, that's when you really can bank on having a very healthy retirement because your money is compounding without the fear of loss and without the threat of taxes. So that's an important thing to look for.
I love it. I love it. And then last thing is for the cash value of a policy, if somebody was going to invest in a property, they can actually use that cash value at any time, right?
Well, not at any time, again, depending on it. If someone has a policy for 10 plus years, now the policy is mature, it's healthy, kind of like a tree, it's deep rooted enough. When a tree is first planted, the winds can still take it. It's still a little flimsy. So once the policy is mature and it's properly funded, and say you have now 200 or 300 grand in your cash value, you've had the policy 15, 20 years, you have $300,000 in the cash value. Can you now access, say, $150,000 to buy your property and use that sort of like a self bank? The answer is yes. But it's important to understand that to arrive in that situation, someone's got to be pretty committed to it initially.
I love it. Cool, man.
Let me say this to you. We have a concept. It's like, hey, pay yourself first. So most people don't look at the accumulation of money in their policy because they're busy spending their money on other things. So being fiscally committed, being fiscally responsible, looking at the big picture, accumulating wealth means you pay yourself first. Before you pay your bills, you pay your investment first. That's what I've seen happen with so many successful, wealthy people, that the minute they make money, they look to save and invest first, and then they spend second. Versus your people who are constantly having financial problems, they make money and they pay all their bills first, and then they spend, and then they have very little or no money to save, and then life goes by. Every month it looks the same. 20 years later, they're busted, they're broke, they're having financial challenges because they never adapted the habit of pay yourself first. So I hope that
Here's
helps.
what here's what I did forget to ask you. How do you determine like how big of a permanent life insurance policy you should get?
Typically, the recommendation would be 10 times your income. I mean, if you make $50,000 a year, times 10 is 500,000. If you make $100,000, you should have $1 million policy. I mean, that's a pretty standard rule of thumb. There's other factors that could be utilized, but overall, how much life insurance do you need? If something were to happen to you, how much do you want wife and kids to get? So those are numbers that you should go over with your agent. You should talk to your financial professional. I'm obviously available to speak to people, and we're very candid, very truthful about what product would be good for what family. And there are some people who want the product, but they're not just quite ready there. It's a good place to start with term, and then you can convert it down the road. So I
Yeah.
hope that answers your question.
And then how could people get in touch with you? Like if somebody wanted to connect with you, they liked the information that you offered, what would be the best way for them to get
You can
connected with
directly
you?
call my office. My office is here in Glendora, California. Telephone number 909-397-8777. Or you can also hit me up on Instagram. It's Coach G Haro. Is this how you heard it? Like basketball coach. So Coach G Haro, Gharo. And then you can also hit me up on Facebook. I'm on Facebook. I'm on Instagram. I'm also on YouTube. So Guillermo Haro, Team Conquer. So I'm all over the place. You guys can get a hold of me that way. But my office number here, 909-397-8777, Monday through Friday, typically 10 o'clock in the morning to 6, 7 p.m. We're open.
I love it, man. So for our viewers out there, I just want to say thank you to you, Guillermo. I want to say thank you for obviously coming on as well too and sharing this information. Today we had Guillermo Haro. He explained to us what is permanent life insurance policies. He went over whole life insurance, universal life, index universal life, and variable universal life. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode would be valuable to somebody else, make sure to hit that share button. Thank you again, Guillermo, and to all of our viewers. Until next time.
Very good. Thank you so much, you guys. See ya.